Hi, good afternoon, everybody. Thanks for joining us for the webinar, Maximizing Your Time as a Small Business. We're going to go ahead and get started. Started with some legalese. What else would you expect from us as a law firm? But we're just wanting to underscore here that we're not providing legal advice. We just hope this will be a good, informative webinar for you to understand some of the strategies that you may be able to implement when you're trying to stay small as long as possible. My name is John Williams. I'm one of the presenters today. I'm a partner in our government contracts group, and I'm joined by Dean Nordlinger, who's a partner in our corporate group. This webinar is really a great symmetry of two different practice groups that we have at PilieroMazza. And as many of you probably know, we're a law firm in Washington, D.C. We've been around for more than 25 years. We're primarily known as a government contracting firm over the years, but we also have robust practice groups in corporate, labor and employment, litigation, and a variety of other issues. So I encourage everybody to check us out on our website and the various other ways that you can follow what we're doing here. So as I mentioned, the presentation today is a great symmetry between two of our practice groups, GovCon and Corporate. And Dean and I work hand in glove on projects like this frequently, and that's why we thought this would be a great webinar topic. We hear from a lot of clients. Dean does in his corporate practice, and I do in the GovCon practice, that hey, look, we're a small business, and that's a critical asset for us, and we're seeing based on how we're progressing that maybe we're going to lose our small business status at some time in the next year or few years, and what can we do to sort of plan for that smartly and get out in front of it. And in other cases, we hear from clients that they're going to lose their small business as of January 1, 2016, and obviously a lot shorter window on what can we do. So the hope today is to walk you through those scenarios, almost as if you were that new client coming to us, telling Dean or telling me that you want to try to manage your small business status. And so we'll lay out for you first, why does size matter, and what are we really talking about when we're talking about small business status. And then we're going to dig into our toolbox for maximizing your time as a small business. What tools do Dean and I use that work? What tools do clients often think work, but generally they may not actually work? And then we'll wrap up with a brief mention of a tool that may be coming down the road. Again, all geared towards maximizing your time as a small business. And then we're going to do our best to stop about 10 minutes or so before 2 o'clock so we can answer questions. So please feel free to type away, ask as many questions as you'd like. We will answer as many as we can during the webinar. We'll answer them all anonymously during the webinar. And any that we aren't able to answer during the webinar, we'll follow up with you by email afterwards. And also, everybody's going to get a copy of the slides. If you haven't downloaded them already, they'll be emailed to you after the presentation, and they'll also be available on our website, PilieroMazza.com. All right, so with that, let's set the stage for the discussion of how you can maximize your small business status by understanding first, why does size matter? Being a small business is an essential ingredient for all of the SBA or federal small business contracting programs. Yes, you have to be owned by a disadvantaged owner or a service-disabled veteran or controlled by a woman, but first and foremost, you have to be a small business. And being small also is advantageous for you as a contractor in other respects. You're exempted from certain requirements like reporting executive compensation or having an ethics compliance program. Certain cost accounting standards don't apply to you as a small business. So being small is important in a variety of ways. And how SBA determines small business status, therefore, is important for you to understand if you're going to try to maximize your time as a small business. If you're in these programs, you're probably already well aware of all this, but it's, I think, worth reiterating that the SBA looked at your average annual receipts or your total number of employees to determine if you're a small business. And each NAICS code, for your industry is going to have an NAICS code, and each NAICS code is going to have a size standard that the SBA has established, and that size standard is either going to be based on revenue or employees. It depends on the industry. If you have a revenue-based size standard, then we're focused on your annual receipts, and the last few bullets on this slide describe how the SBA calculates annual receipts. They're going to look at total income plus cost of goods sold from your tax returns. If you don't have tax returns for one of the years the SBA is looking at, because maybe you haven't filed yet, the SBA will look at your financial statements. But that's what they're going to be zeroing in on to determine your average annual revenue. There are not very exclusions exclusions from your revenue that the SBA will consider. They're all listed right in the SBA's regulation. So if you don't see it in the regulation, you can't exclude it. But some of the limited exclusions include sales taxes and franchise taxes collected and given to a taxing authority. Earlier this year, SBA proposed a rule that would include passive income in the calculation of annual receipts. And I also wanted to mention how SBA handles a short year, because this may be relevant as we get later into the discussion of corporate restructuring and things you can do to maximize your small business status. You may end up with a short year, and if that happens, the SBA, they have a metric in their, or a formula, I should say, in their regulation that they use to annualize your revenue from the short year. So, having a short year isn't necessarily advantageous for you from a small business planning standpoint, but I just wanted everybody to understand how that works. Turning to the next slide, again, still on how does SBA determine your small business status, the period of measurement. If you have a revenue-based industry, they're going to look at your 3 most recently completed fiscal years. So if SBA was measuring your size right now and you're on a calendar year, fiscal year, then the years we care about are 2012, 2013, 2014. They're going to average your revenue in all 3 of those years, and they'll see if the average is above or below the size standard for your industry. If you have an employee-based industry, they're going to average the number of employees that you've had during each pay period over the past 12 months. And then this is another important point. If you have affiliates, then this is how SBA is going to determine your size. They're going to determine your size based on your average annual revenue or employees plus your affiliate's average annual revenue or employees. And so you can see then that if you have an affiliate, that can have a real impact on your size status. You may be small on your own based on your own average annual revenue or employees, but when you add your affiliate's average annual revenue or employees, that might knock you over the size line. And we're going to come back to that. I'm going to now turn it over to Dean to talk a little bit about SBA's former affiliate rule.
Right. Thank you, John. Thank you, everyone, for joining us this afternoon. So as you can see on the slide, we're going to talk about the former affiliate rule and how that plays into your current size and how you may be able to reset your size. So I think a fair and a good way to think about the former affiliate rule, which is this, speaks specifically to this SBA rule regulation about if another entity was once an affiliate of yours and is now no longer an affiliate of yours, it allows you, it creates a path for you to be able to back out the affiliated revenue. We have this example here, but big picture wise, what I want to say is that you should have in your mind that this rule really represents a possible strategic pathway to reducing and resetting your company's size and therefore preserving your company's time as a small business. So with that said, let's look at the example. It's a very straightforward example. Company A and Company B over this 3-year period, 2012 to 2014, each have 20 million in revenue, and because these two entities are affiliated with one another, and there are different ways we'll get into in the slides later about how they are affiliated with one another, but take it presumptively they're affiliated. Therefore, A, which only has 20 million in revenue, with respect to determining its size, really is a $40 million entity, right? So what on a go forward, what it does is, as of this mythical or example date, November 1, 2015, A and B fracture their affiliation. Okay, so for the moment, like I said, we're going to, on later slides, we're going to get more specifically into what fracture means, but just as a concept, put in your head for the moment that what that really is all about is the concept of substantially, if not completely, severing the ties between the two companies, and that's how you fracture the relationship. So here we've given you this rather straightforward example where A and B are affiliated, they fracture, and so A moves forward to wants to submit a bid, a proposal, and because it's fractured that relationship, it is now literally 1/2 of the size it was moments ago. A rather empowering kind of opportunity to go from not small to now I am small. But let's talk about the fact that in the operating reality of many companies, your particular company, your operating reality may be a little more complicated than that. And so in other words, if all of the business and operations are housed within one company, then there is no affiliate, right? You have no affiliate that's a current affiliate that can become a former affiliate because there are not two companies. In other words, there's not a parent and a subsidiary or two sister companies. In our hypothetical example we gave here, it was implied or assumed that A was the parent of B, or A and B were sister companies. Okay, so with that said, I think we'll skip forward to the next slide.
Yeah, and I think just to reiterate the point that Dean made, the retroactive aspect of this is what I think is really important to keep in mind about the former affiliate rule. That's what this simplistic example draws out, that although during 2012, 13, and 14, these companies were affiliated, they didn't break the affiliation until 2015. But once that affiliation is broken, retroactively between 2012, 13, and 14, the former affiliates' revenues come off the books. So company A is now small during that period, even though when it was actually in those years, it was affiliated and not small. So and I think we'll drill down more on that as we move forward, make it clearer to understand, but it's a really key tool for what we're trying to do here in maximizing small business status.
Yeah, thank you, John. It's very helpful. So as we left that prior slide, the notion there is that realistically, in order to make use of the former affiliate rule, what may be in play for your company is to think about and think through a possible corporate restructure of your business. All right, so having provided that background context with that prior slide, why don't we take a look at what a possible corporate restructuring might entail? And as we do that, part of what we want to do here is drill down on what is a quote-unquote affiliate under the applicable SBA regulations. And the SBA defines a business concern or a concern as a separate legal entity. So let that sink in for a second. So in other words, generally speaking, if you want to position yourself to be able to reduce and reset your size, particularly by way of a revenue-based size standard or employee-based too, then company A, if you think back to our earlier example of company A and company B, company A would have to fracture from a separate but related legal entity and not, for example, sell off directly from within A itself a bunch of assets. That's not going to work. You wouldn't be able to sell $20 million worth of assets out of your own company and then reset your size for the 3 prior years. That won't work. So now, having said that, I do want to muddy the waters just a little bit from the perspective of saying, well, okay, but what about if you were to truly sell a division or a business unit from within the existing company? There is a little bit of case law, and you might want to weigh in here, but it's a little bit of case law that is supportive of the idea of what one judge in one case referred to as a quote-unquote cognizable business unit, which opens the door to the possibility of, continuing with our hypothetical companies or company A, being able to sell from within itself a segregable, standalone, fully identifiable operating division within itself and trying to reduce and reset its size. But having said that, there's not a huge line of case law supporting it. There's a little bit of case law you could look at, relative to supporting that idea. And then, just so that it's on your mind, because, and this is where I think the regulations kind of move back and forth a little bit. You heard us say a minute ago that if Company A were to sell a substantial bucket of assets out of itself, that wouldn't position A to reset its size. However, there is another rule, right? It's a sort of the successor and interest rule that says, well, if Company A were to have gone out and bought a substantial bucket of assets from an unrelated third-party company and brought those assets into itself, and the assets that A brings into itself are of a substantial enough size and amount so that post-acquisition of those assets, the identity of A has arguably changed enough, then Company A is going to get tagged, or likely going to get tagged, with the prior revenues of performance of those assets. So I think there's a little bit of a, I feel like you get a little bit potentially whipsawed by the regulations in that respect. I'm going to turn it over to Steve.
Yeah, I think those are very good points, and I think what you take out of this, and again, we're setting the stage right now, trying to give you the foundation for the SBA rules that are going to be underlying the various options we're going to run through here in the next several slides. And this former affiliate rule, you can see that I think what we're trying to convey here is that it would work best in a situation where A and B are separate concerns. They meet the definition of an affiliate. And that was one of the questions I see, one of the questions we got here is, how do you define an affiliate? And I think we've done that here, and we'll talk in a few slides about the different ways that you can become affiliated. But a separate concern, an LLC or a corporation or a partnership, a separate legal entity, that in terms of selling it to the SBA, that's going to be the easiest way to demonstrate to them that we were affiliated today and we fractured the relationship, and so we're no longer affiliated tomorrow. That there's a former affiliate. But that doesn't mean you can't necessarily pull it off if we're talking about a division or a business unit, or if we're talking about purchase of assets. It's becomes maybe a grayer issue as to how well it'll work at that point. But there's a lot of different permutations that this could take on when you're trying to use the former affiliate rule. Right. And just to answer another question we got here to confirm. So then the question we got is, at the point that company A and B split, the questioner is asking, so you don't have to look back over 3 years and include the revenue from B? And the answer is right. Yes, that's right. Once A and B split, and there's a big asterisk on that, because it's got to be a clean break, and we're going to talk about this as we move forward. What do we really need to do to accomplish this fracture? And fracture is a buzzword we're going to keep coming back to. But if we do accomplish the fracture in the way that we need to, when A and B is split, you do not have to include B's revenue when you look back over the 3 prior years to determine A's size. Okay, so now we're going to move to the toolbox, and as we've described it, the different options. And I think, good segue from our discussion of affiliation into the first thing that you can do, and this may seem obvious, but the first thing you can do in maximizing your time as a small business is make sure you understand affiliation, because affiliation can cause you to lose your small business status. The way I described that you add your revenue plus your affiliates revenue. So at a basic level, SBA is going to find a company to be affiliated with you if it has the power to control your company or you have the power to control it. That affiliation is all about control. At the end of the day, that's what the SBA is looking for. So there's a variety of ways that they can find control and affiliation. That could be common ownership and management, could be shared facilities or employees, close family connections like businesses that are owned and controlled by a husband and wife or a father and daughter, economic dependence, which can happen when one company is getting a large portion, 70% or more of its revenues on contracts with one other company. The SBA can find an economic dependence through that contractual relationship. And in fact, earlier this year, SBA proposed a rule change that is going to put 70% right into the rules. Right now, the rules don't specify a percentage of revenue where economic dependence will arise, but the case law has said 70% over the years, so the SBA is just going to go ahead and put 70% into the rules. At least that was their proposal, which might be finalized later this year, probably more likely early next year. So knowing these different ways you can get affiliated is really critical, because it's just affiliation is a really important aspect of managing your participation in these small business programs. So building on that, then, what can you do to avoid and mitigate affiliation? Your corporate transactions, and Dean can speak to this very well. There's a lot of potential for affiliation that arises when you're considering a transaction. I mean, even from the point that you're doing the LOI, can create a letter of intent, can create potential size and affiliation issues. So you need to be proactively assessing that from a very early stage in the corporate transaction. Bringing on new owners is another type of a corporate transaction that could potentially create affiliation issues, because what does that other owner also own or control? Your corporate records, particularly for the smaller businesses that are just getting started, where maybe you grabbed your operating agreement from LegalZoom or just off of Google and didn't think a whole lot of it. Maybe at the time you were the only owner, so didn't think it mattered very much, and since then you've grown and now you have a few owners. And there might be negative control issues in your corporate documents you don't even realize. And what I mean by negative control is that there might be a provision that says the company cannot take a certain action without all of the owners approving. And that gives that means even the guy who owns 75% of the company doesn't control the company for that particular decision. The minority owner, the 25% owner, has negative control because he can vote to block the action. So, and that can give rise to affiliation issues. So understanding, where there's potential landmines might be in your operating agreement or your bylaws, shareholders agreement, et cetera, is really key. Diversifying your teaming partners, of course, that goes to the economic dependence point that I was just making. Understanding that your family member's company could actually create an affiliation issue for you. I think that one comes as a surprise to a lot of folks. So you mean that my brother's company could potentially be affiliated with mine? We don't do anything together. we're not in the same line of business, and that's not an automatic affiliation. There's a presumption of affiliation between family members, but you can rebut it. But to rebut it, you at least need to be aware that the potential is there, and take steps to try to mitigate it, address it up front. Making sure your website and your marketing materials don't give the wrong impression about affiliation. We do a lot of protests here, and whenever a client calls us and says, I want to file a size protest against somebody, one of the first things we do is go on that company's website. And the website is often a treasure trove of information that we can use to bolster our size protest against them. They may have it could be outdated, but there may be information about old office they used to share with a much larger company, or information disclosed about ownership structure that leads down a rabbit hole that ends up supporting an affiliation argument. So be careful of what's on your website and other public databases, etc. And structuring your teaming and subcontract agreements really carefully. The ostensible subcontractor affiliation is a type of affiliation that's very commonly coming up in protests, and it's really centered on your teaming agreement with your subcontractor. How did you structure that relationship? Is that subcontractor too heavily involved in the key aspects of the project? And these are things that you can manage up front and prevent you from losing a contract. Ostensible subcontractor affiliation won't wreck your small business status in general. It's not an ongoing problem for you. It's a contract-specific problem, but it could wreck your small business status for a particular contract. If your sub is a large business and you're affiliated with them for that contract, you're going to lose that contract. So it's contract-specific is another really important aspect of this ongoing analysis and understanding of how to see these issues and take steps to avoid them. I'm going to turn it back over to Dean now to talk about some on the corporate side, getting your house in order.
Right, thank you, John. So in terms of, as we look at this slide, you could really break this out into two categories, and what we're really trying to communicate to you here is that when it comes to affiliation with third parties, it can be created by internal contractual arrangements made within the ownership and management structure, but at the same time, it can be created by external contractual arrangements with unrelated parties. With respect to internal contractual arrangements, as you can see, we've alluded to the bylaws and the shareholders agreement or the operating agreement, and John touched on this a little bit a moment ago. What we're really talking about there is doing what you can to appropriately thread the needle and really differentiate between the day-to-day management and operation of the business versus what we'll just sort of stylize as a limited bucket of minority owner protections, where as a minority owner you are going to have a reasonable set of expectations that there are certain matters that you wouldn't want the company to undertake without your ability to be a participating and blocker vote in that. Amending the articles of incorporation, admitting a new member, things like that. But when it comes to the material day-to-day and operations in terms of setting compensation, hiring and firing people, what you really want to do there is you want to avoid supermajority or unanimity voting requirements on material business decisions that would affect the small business owner's ability to manage and conduct the company business. That's kind of where you really want to go with that. On the other hand, when we're talking about external contractual arrangements, what you heard John touch on was thematically, you want to avoid what we'll call consistent, ongoing, and overly concentrated business dealings with one third-party company and or being too reliant on that one third-party company, as opposed to being a business that has diversified business dealings with multiple third parties. And as you can see on the slide here, there are any number of these relationships with third parties that in the right or wrong combination, however you want to phrase it, could find you to be affiliated with them, notwithstanding that there's zero common ownership in them. None if you want to say anything on that.
Yeah, I mean, and to one of the questions here, we have a question about whether two parties that are equal owners of a JV, even though there's no controlling member because they're each 50-50, would they be considered affiliates? And I think the answer is yes, because the joint ventures is one of the ways that the SBA finds affiliation. Parties in a JV are considered to be affiliates. And I don't think it's going to make a difference in that analysis that there may not be a particular company that's in control of the arrangement because they're in a joint arrangement together. The other thing is that common ownership, which I mentioned is another way you can get affiliated. That common ownership rule says that if you own 50% of an entity, you are presumed to control that entity, and that's an irrebuttable presumption. So in the case where two companies each own 50% of a JV, they're each going to be considered to be in control of that JV. So they're going to be, they're all going to be affiliated with each other in that scenario.
Yeah, I was just going to add, because this comes up sometimes, that, and this is, as John mentioned, I think this is one of those places where the practices are very well integrated, because when you think just purely under a business and corporate law perspective, when you talk about, well, what's an affiliate, right? You really think about, well, company where there's common ownership, that kind of thing. But in the regulatory context, particularly when we look at this totality of circumstances, the concept of what an affiliate is much more expansive. And I think that that example right there is actually one where you could kind of put it in either bucket, right? Because that 50-50 where there isn't, it kind of is controlled by both. But to your other point, that just on a regulatory basis, it gets shoehorned in there.
Yeah, and let me just make sure it's clear. JV affiliation is a contract-specific affiliation. So if you form a joint venture, you're considered to be affiliated with your joint venture partner for that contract, not necessarily an ongoing affiliation outside of that contract. So, and this is to another question that was asked, if you dissolve the joint venture, would that fracture the affiliation? Yeah, once the joint venture goes away, or once you're done performing the contract that you formed that joint venture for, that joint venture affiliation goes away. Now, it's possible that you could end up with an ongoing affiliation if you do so many joint ventures with another company that it just looks like you have a real commonality of interest, that you're if so many contracts together, it's a large portion of your revenue, all of your eggs are in that same basket, that maybe you end up with an ongoing affiliation. But in most cases, joint venture affiliation is going to be contract specific. And that's actually a good segue, because the next tool that we want to talk about in maximizing your small business status is using joint ventures. And there's 2 points I want to make about the use of joint ventures from a maximizing your small business status standpoint. One is it helps you manage your revenue growth, and 2 is it gives you the ability to chase larger contracts. So on the revenue growth side, as a prime contractor, 100% of the contract revenue is going to go on your books, so to speak, even if you end up subcontracting 50% of the work or 85% of the work or whatever it is for your industry that you're allowed to subcontract. So that's potentially a whole lot of revenue going on your books, impacting your small business status, when that revenue really, it wasn't for you. It was passed through to your subcontractor. In a joint venture, the revenue attributed to you is in accordance with your ownership interest in the JV. So if you're a 51% owner of the JV, you're going to get 51% of the revenue. You're not going to get 100% of the revenue. So for the prime contractor that knows it's going to have to do a lot of subcontracting on a particular project, you may want to think about doing that project in a joint venture so that you can limit or manage the revenue that's attributed to you and give you a little bit longer horizon as a small business. The other thing about joint ventures is that they're often used and helpful to pursue and win larger contracts. And if you can combine with a SBA mentor-protege relationship, your joint venture could include your large business mentor. You cannot JV with a large business unless you're in an SBA-approved mentor-protege relationship. But if you have that approved mentor and you do a JV, that JV is probably going to be able to go after much larger projects. And so, because there's a lot more capacity, there's two companies in the JV, and one of which is very large and could be the incumbent. That happens a lot, where the project was full and open, and then it went set aside. So the large business incumbent is looking for a JV partner to go after the recompete. And as a small business, the reason that I put this in the presentation on maximizing your time as a small business is because, you don't want to just be a singles hitter the whole time you're a small business. If the plan is, I'm not going to be a small business forever, if everything goes the way I want it to, eventually I'm going to become large, you'd like to not just trip over that line from small to large. You'd like to go sailing past it. And so you're going to want to swing for the fences with larger contracts as you get at least later stages into your small business status, and get some long-term small business contracts under your belt before you graduate small business. Because if you're small when you win the contract, you're small for the life of the contract, with some exceptions, and we'll get into that. But as a general rule, it's good to get some larger contracts under your belt as a small business before you graduate, and this is a good tool to do that with. And we do have, right now, the only mentor protege program available is for 8A companies through the SBA, I mean. But the SBA, as you may know, proposed earlier this year to expand the mentor protege program for all small businesses. Hopefully we'll see those rules implemented sometime next year. So maybe within the next year or so, we'll be ready for all small businesses to start applying for approval of mentors, and then all small businesses will be able to use this joint venture tool.
Great. So shifting back now, as we go into this next slide, I want to go back to one of the earlier slides where we were talking about the possibility of a corporate restructure, and we kind of went by it pretty quickly, so I just want to come back to it now, slow down for a minute, and talk about and think through what specifically that might look like. You would kind of lump this in as part of what I would call planning early, or planning earlier on in your company's business life cycle, because it truly is the most advantageous way and approach to doing things. As John mentioned, sometimes we're working with clients who are looking at an issue like this, and we get a really long tarmac to work with them to do it. On the other hand, sometimes they come to us at the proverbial 11th hour, and it's a little more difficult to make something happen. So there's a list of questions here, and they're very helpful from the perspective of thinking about, okay, well, if today you have one company, right, and you think to yourself, well, as I look at my business, I've got a couple of different divisions, and I almost really have two distinct employee bases, meaning that the assets that are allocated and used in your divisions aren't really interconnected. I mean, they're largely segregated from one another. The answers to those kinds of questions help you sort of think through and sort through, well, would it make sense, for example, if you have one particular company that has two operating divisions in it, would it make sense to take operating division 1, create a new company, take operating division 1, drop it down into a newco, an operating subsidiary, and in exchange for that, the existing company would take back 100% of the ownership interest in that newco. So now all of a sudden, what we have is a parent company and a subsidiary. And what that really does from a planning perspective is create from the beginning, or as early on as possible, a clear or clearer history of separateness between the affiliated entities, so that on a going forward basis, if you were going to fracture, you would leave no doubt about the fact that you had successfully fractured. Go back to that earlier example of Company A and Company B, where they were two separate legal entities, as opposed to, say, just operating divisions or baskets of different assets that are sitting inside of one company. And, again, other things that are powerful about that are, if and when you want to sell that second company, you're going to avoid the need to assign and transfer prime contracts from one company to the other, because they already are where they are. And separately, you're going to create more flexibility in an overall sales scenario, whether you want to do a stock deal or a merger or the like. So I think we'll go to the next slide. Mm-hmm. So, okay. If you have a sale of an affiliate, what is that going to look like? So there's two topic points here, right? Novation and recertification. So simply put, if there's an asset sale, you're going to trigger novation. That's going to happen. You want to move a prime contract from one company to another, you're going to have to novate. On the other hand, if there's a stock deal, it's just a change of ownership. There's no requirement for any kind of novation of contracts. The concept of this, what we've been talking about, this corporate reorganization, kind of a gray area, because there's some case law that would suggest that when you are moving contracts within a family of companies, that there's a by operation of law exception that would maybe make it more like a name change and not have to formalistically go through a full novation process. On the recertification front, as we list out here, you're not going to get around recertifying. You're going to, no matter what kind of deal you structure, there's going to be a recertification. I'm going to go back to John in a minute about some of these more specific things. But what I did want to point out is that, and I don't want to oversell it or overstate it, but there is, historically speaking, as owners of government contracting companies, you're very familiar with the notion of novation, and therefore lots of transactions are structured as stock sales in order to avoid that. But in the small business arena, when you are attempting to maximize your time as a small business, there is a possible emerging trend relative to the idea that, well, as opposed to doing a stock transaction, which triggers both the buyer and the seller, having to recertify on the contracts, if it's an asset purchase, there's an argument that the buyer does not have to recertify its small business size as to the existing contracts with the buyer, but only as to the asset, the contracts that have been purchased. So I just kind of put that out there because it kind of creates a little bit of an interesting contrast, and we've been seeing a little bit of this about as a part of an overall strategy. But having said that, I'm going to turn it back over.
Yeah, I just wanted to chime in. The last bullet here is one I put in because the SBA proposed this earlier this year, that the proposal says you'd have to recertify your size on pending proposals if there's a merger or acquisition that you go through after proposal submission but before award. And while the rule doesn't say what has to happen as a result, that they have to terminate your proposal or eliminate you from the competition, I think the reality is that's what's going to happen in most cases. If you submitted a proposal for a small business contract and then you sent the CO a note while they were evaluating saying, well, by the way, I'm no longer small, I don't think they're going to consider you anymore. And the SBA's position on this is that, well, then you should just wait and do your deal after the contract is awarded. And I think they believe you should lose that proposal. So we'll have to see how that rule gets finalized, but that's an interesting potential addition to the size recertification rules that we have.
Great, thank you. So going forward, let's just going to spend a little bit, and we're running short on time, so we're going to pick up the pace a little bit, but this concept of the fracture and the clean break, suffice it to say that if you're going down the path of wanting to take advantage of the former affiliate rule, and you really, as best as possible, are going to want to set up for, as you can see on the slide here, this clean break, because any lingering ties, all that does is really muddy the waters about whether you really no longer are having anything to do with one another. And I don't know if there's anything in particular you want to highlight on these types of things we've seen or not seen.
Yeah, I mean, I think it goes back to the the fracture and the negative control. If you're changing your ownership structure, do the people that need to control the company, do they control it in all respects? What type of ongoing relationship is there still going to be between the companies on the other side of this break? Oftentimes clients would like there to be more of a relationship going forward than we think is advisable. If you're trying to demonstrate a clean break, that really, in a perfect world, means one of the, you're riding off into the sunset, going in your separate directions. That's not often, the case or the preference. So we have to look at these different ties that might linger and assess how much of an affiliation risk do they prevent. And these are the types of things that could present issues here.
Thank you. So there's a little bit of a subtle shift here. So a minute ago we were talking about selling off an affiliate in its entirety, that fracture, that true and clean break, and bye-bye, gone. We've certainly, having said that, we have, John and I together have worked with a number of clients where, the concept of going down the path of a true third-party sale sometimes is not nearly as easy as you would like it to be. And by the same token, that may not even be your true goal, because we have worked with clients on, let's just call it an alternative path to reducing and resetting size by splitting up or otherwise restructuring a company or two sister companies, to the point where we've been able to sort of recalibrate what the ties are between the two companies, so that from the perspective of how, on a go-forward path, what do they look like, who are the owners, how are they managed, how are they operated, what is the business that's transacted, whereas earlier it were two companies that were truly undeniably connected. We've sort of been able to rework the structure to create it where we now have two companies that are not affiliated. But I do want to stress, in doing that, it's very interesting working with clients. It can't be any kind of ruse. I mean, it really has to be a bona fide scenario where you might have been the controlling owner of two different companies for a long period of time, and you've sort of said, I'm willing to completely give that up and become an entirely passive, less than 49% owner in a business. And I'm oversimplifying it because of time and other constraints, but that is sort of an alternative path. That's why you see the slides, we differentiate between sort of a sale of an affiliate and the fracture of a business relationship, just to kind of couch it in context. Mm-hmm. But I think we should move forward.
Okay, so another option that you could look at is changing NAICS codes, because as I mentioned early on, the NAICS code sets the size standard. So in terms of if you're participating in an SBA program where you have to be small in order to participate in the program, that's going to depend on your primary industry. And the SBA is going to judge your continued participation based on that primary industry, and that's typically going to be based on the industry that you're earning most of your revenue in. So you could look to diversify your revenue in order to potentially move into a different primary industry that has a higher size standard, will give you longer room to grow in that program. And on contracts, the NAICS code assigned to the contract is going to define what the size standard is for that particular contract. And the contracting officer has discretion. I mean, it has to be reasonably exercised, but the CO has discretion to assign the NAICS code that he or she thinks best fits the work. And it is often the case that more than one code could conceivably fit the work. So if there's a code with a higher size standard, obviously you would want to advocate for that higher size standard code to be assigned to the contract. And we've worked with clients to do white papers and other sort of marketing type efforts with agencies to switch to different higher NAICS codes. You can also appeal a NAICS code to SBA's Office of Hearings and Appeals. If a contract comes out with a NAICS code and a size standard that you think is too low, or you might, and conversely, think it's too high, you can appeal that as long as you have to go within 10 days after the solicitation's issued, so you can't sit around on that one, but you have the right to do that.
Okay. So other things that you might be able to do, John alluded to earlier, what's the calculation of receipts, and there are certain things that are excluded. So really just sort of want to raise and dismiss this as it's a technical point that you can explore, and one that may or may not, bear any significant practical effect. But it's something that, the company would, logically want to do in consult, with this outside tax and accounting advisor to conduct the exercise to see whether there are in fact any corrections that would need to take place. And as John said, you'd want to amend the you'd need to amend the return prior to submitting the proposal. And I don't think there's more to say about that. Mm-hmm. So on this slide, what we're really wanting to share with you is techniques that in one case typically outright do not work, or in another context really have a short-lived impact. And so the first one being creating a new company. So creating a new company isn't going to work from the perspective that, there's still going to be common ownership. It's a newly organized concern, and the totality of the circumstances of these two entities are totally tied together. So that is, kind of raise it to dismiss it. Changing a fiscal year, certainly that's a possibility, but at best, I guess we typically look at that as a short-term fix, and you need a legitimate business reason to do it. For example, to match to the government fiscal year, and in some cases, you may even need the IRS's approval to do it. I'm going to turn back to John just for a moment, because you had mentioned earlier about the shortened year, and if you.
Yeah, I mean, I just think people ask us about these things, and we're not totally dismissive of them as a potential. I mean, theoretically, I guess you could start a new company with completely separate ownership and a completely independent new business, and yeah, it would be small, but most of the time what people want to do is they just want to spin off a new small business from their existing company with the same owners and say, well, just because we just started it, so it's small, right? It has no revenue, but there's going to be affiliation issues, and that's why that approach generally it doesn't work. And changing your fiscal year, you could do that and create a short year, and depending on the way that you do your accounting, and depending on whether your revenues are sort of backloaded towards the beginning of the year, towards the end of the year, or front-loaded, maybe that would work for you in that particular year. But it's like Dean said, it's going to be just a short-term fix. And then, clients ask us about delaying submitting their invoices and or cashing checks, and I think we sort of hold our nose at that one, frankly. I mean, it's
I guess and John, I think John has said it well. I mean, but on that particular point, I mean, I think the way we sort of look at it is, well, first of all, I don't think the SBA regulations preclude it. Having said that, you have to sort of look at the totality of where you find yourself. So, for example, with respect to your bank line of credit, or what the requirements may be under a particular contract you're performing, whether something like that would put you in conflict with those provisions is really a whole separate question. Mm-hmm. And then again, this is one of those things where your professional advisors can be very helpful. I would say in this case, in this context particularly, your tax and accounting advisor to help you look at something like that and whether and to what extent it actually makes sense.
Yeah. Yeah, so that's why we tongue-in-cheek call these tools gold. I mean, they're not necessarily options that you totally cross off the list, but they're certainly not part of the more considered planning options that
Like
the longer term options that we've been talking about. But sometimes you got to pull out all the stops. All right, last couple things we want to talk about before we wrap up, and we've answered a bunch of the questions, but it looks like there's still several more, so we'll try to answer a few before we have to sign off. You can wait out size standard increases. So I chuckle a little bit as I say that, because waiting that out may not be very realistic for many of you, but depending on where you're at in your cycle as a small business, that may work out just fine, because the SBA increases the size standards periodically. Just recently, we've been going through a several-year phase of very detailed review and increases for all of the revenue-based size standards. So I think that level of close review probably is not likely to happen again very soon. But there was just an inflation adjustment for size standards last summer. So I think most of the size standards ticked up a little bit as a result of that inflation adjustment. The SBA is supposed to at least assess the impact of inflation every 5 years. That doesn't necessarily mean they're supposed to change the size standards every 5 years, but they're at least supposed to make that assessment. I looked back historically, it seems more recently, like the last 15 years or so, they've tended to do this inflation adjustment every 3, 4, 5 years. So we might have another one, maybe 2018, 2019. We'll see size standards increase a little bit. And then another component of this is that it looks like in the 2016 National Defense Authorization Act, we're going to get a provision that allows contractors to challenge size standards to SBA's Office of Hearings and Appeals. So I think that's a really interesting development. I don't think the NDAA is completely buttoned up yet, although I think it's to the president to be signed at this point. So assuming that gets passed, I imagine we're going to have regulations before it's truly an option that we can utilize. And I think a lot remains to be ironed out in terms of how feasible is it going to be for a contractor to actually challenge and win the SBA size standard, because a lot of analysis goes into the determination of the size standards, and the contractors are going to have 30 days after the proposed size standard increase is published in order to file the challenge. So, realistically, I don't know that many small business contractors are going to be in a position to put forth an effective challenge. But, some, if you're watching it, and preparing for it and ready to file as soon as there's a proposed change in the size standard, that we may be able to work with that as a viable option. So I think it's interesting development, and we'll keep an eye on that going forward. All right, everyone. Well, I think we pretty much, I've got maybe 2 minutes left on my clock. So thanks for participating. Let me scroll through a few questions, try to answer a couple here. I got a question on, with regard to employee leasing, does that include PEOs, professional employment organizations? Why is that an affiliation? There is an exemption for relationships with PEOs. If you're leasing from a bona fide PEO, that's most likely not going to create an affiliation. It's really, the sharing of employees is really an issue when it's between companies that aren't in the business of leasing personnel. Somebody else asked, if an agreement has a transfer restriction, does that lead to a finding of control? It can. Transfer restrictions can be an issue for some of the small business programs, like 8A or the SDVOSB program. If there's a restriction on the veterans' ability to transfer their stock, that could be an issue.
Yeah, I think that, let me just piggyback on that. So historically, in our view, if you're an 8A company and there's a right of first refusal of a minority owner to acquire the stock of the 8A owner, generally a right of first refusal by itself does not cause affiliation. Interestingly, in the context of SDVOSB, the VA regulations tolerate a right of first refusal as well. On the other hand, the SBA in its SDVOSB regulations do not. So to John's point, this is it's a really good question in a territory where you have to navigate thoughtfully and carefully, because at the same time, when you're looking at all these things, you go back to the totality of the circumstances, and we typically find there's not sort of just one data point. You got to look at the whole relationship to make a determination about whether something is a problem or it's not a problem in terms of the affiliation itself.
All right, we're going to end there, everybody. Thanks again for joining us. There are a few questions we didn't get to. We promise we'll follow up with you by email. If you thought of something as soon as you hopped off, feel free to email Dean and I will be happy to answer it for you. Thanks again, everybody. Bye-bye.